What's going on, everybody? It's Steve here again. Welcome back to the channel. And today I want to talk to you about when it's the right time to sell your stock as a beginner. Just a little hands-on of things to do when you feel as though the time is right, or an indicator to let you know when the time is right for you to sell a stock and not feel bad about it. So I've listed 7 things that I've written down, from my personal opinion, and hopefully they'll help you out in your journey in investing, and where you won't have guilt when you sell a stock. So what I do basically is before I sell a stock, or before I even invest, I put the stock in 3 categories, and how it will affect me in my portfolio. The first category is it a cyclical, is it a growth stock, or is it a blue chip dividend stock? Because I deal with value investing, so depending on what type of stock it is, depends on how long I'll hold it, if it's worth my investment, and will I get value out of it once I get it at a certain price. Now, if you're a beginner and you're going into stocks, these are things you'll learn over time, the different type of stocks. But I just want to focus on the 7 things that I've wrote down that I think are beneficial to where you won't have guilt when you sell a stock. So I'll jump into those real quick. Okay. The first thing I wrote down is, when you sell a stock, the first thing you want to do, the first thing is when the stock explodes without cause. Now, a few months ago, half a year or so ago, if you were new to investing, or if you already are a seasoned investor, you know about AMC and GameStop. Both of those stocks were selling in the low 20s. Some of them are in the teens, and they took off and went all the way up to $80 or what have you, real high, because a lot of people were pumping into the market to make these prices go high. But the thing is with that, if you got in too late, and you brought in around $80 or $90 when your stocks were up like that, and then they suddenly plummeted, now you're in a dilemma to where you're $80 in per share on the stock, and you might not ever get your money back unless it shoots back up, which is unlikely, because stocks like those, per se, like AMC, GameStop, they have a lot to do with the economy. They're more like a cyclical stock. A cyclical stock, in case you don't know, is a stock that's the price is influenced by systematic changes in the economy, overall economy. Examples of cyclical stocks are airlines, casino games, auto stocks like GM, depending on, what the economy is, the popularity. Tesla, Tesla's more of a growth stock, but you understand what I'm saying. Tesla can go up and down at any time, any given time. Disney is a stock that's a growth stock, believe it or not, because it's seasonal. Now, I'm sure they make movies and they have other things that they do that helps them with their revenue, but mainly in the summertime, Disney is the hot stock. Now, as far as when the stock explodes like that, you don't want to get caught up in that. That's a lot of hype. So if you do have these stocks, say you have a stock and the stock explodes without cause, like what is going on, and you're doing research and you're finding out that the company didn't do anything different and there's no real cause about it, me personally, I would do as much due diligence as I could in my investigation. And if I found out that they were just pumping the stock, I would look for a point to get out. That's just me, to avoid loss. Another thing is that I wrote is the competitive advantage of the company is lost. Now, if the competitive advantage of the company is lost, their moat per se, any other competing company in that space, they lose their advantage. Usually, they lose their position, and thus it puts the investment that you have with them in jeopardy. Now, another thing is, if a scandal or some type of immoral act happens within the company management, like example of it was Enron. I wasn't investing when Enron was out, thank God, but a lot of people lost money, and it was a lot of immoral practices. I mean, you could have a CEO, the company's running like clockwork, and the CEO can get caught up in some type of scandal, be it like with somebody, it can be physical, or it could be just something immoral, and it can offset the whole growth pattern of a hot stock taking off with a bright future. Now they got to get rid of the CEO. They got to try to fix the name of the company, the face of the company, get rid of the bad rep. There's a lot of PR, unwanted PR press, and it just doesn't make sense with the company, and you just got to be wary about that. The fourth thing, number 4, the business vision changes. They get a new CEO who comes in, and a lot of times I've learned that CEOs will come from other niches that don't even have nothing to do with the type of company this is, but they're good at building businesses. Now, not taking nothing from the CEO, but sometimes, like, I give you an example, like with GE. GE had so many CEOs when I first started investing in that the stock just went up and then it went down, and then it just finally where they got a new CEO that's trying to clean up the mess from the last CEO, and you just don't want to avoid that. So the business vision changes. The business goes a lot of time with the CEO and the board, and they want to take it to new places, but sometimes it might not agree with what you do, or it might be, hey, I invested in this stock because of this, and I saw them going this way with the vision. Now they're not even doing what they said they were doing, and now it puts you in a position where you're like, oh, well, okay, maybe it's time for me to buy out. And there's nothing wrong with that, because it's your money, it's your investment, and when you buy the business, you practically have ownership in it, so you shouldn't feel bad about walking away from something, especially at the expense of you losing money or being diverted from the vision you had that made you invest. So that's number 4. Number 5, if you need money. Now, say you've been investing for a while and you've got some gains, you've been paid dividends, or the companies have grown, congratulations. But it's no harm in pulling off your some of your gains for your own personal use. I mean, you're investing money to double it anyway, or even triple it. You don't want to borrow from a bank. Some people can't borrow. So it's up to you to pull the money out of the account and do what you want to do. It's your money. You should never feel guilty about that. But that is one of the things. You might need money. You might have something you have to take care of. You've had the money in the market for a while, so you've earned the money, as a business owner. So, that's number 5. Number 6, you find something better. And that's no problem. That goes with number 2, the competitive advantage. Say the company you have, you've invested in it, you've been with it a long time, and all of a sudden, you find something that's in the same, sector, and it's taken off. It's the new thing. Now, it's no love loss between you and the stock that you own, but you have to also think about it like this. I've had this stock for a while. If I've had this stock for a while, if I was going to invest in this stock today, would it still be the same? Would it still be this stock, or would it be the stock that I'm looking at? And sometimes your answer is, tells you what you need to do, or what you should do, or what you feel. You shouldn't feel bad about the decision. Basically, what I'm saying. Last but not least, the stock position gets too big, and this happened to me, and it happens to a lot of investors. It happens to people yearly. That's why they reconsolidate their portfolios. Now, if this happens to you, you're doing well in the market, and you're on the path to financial freedom, per se. Say you have a stock where every 3 months, quarterly, the dividend is paying you in shares, and your shares are just jumping. They're going higher and higher and higher. Now you have another stock that you want to put money into, but the stock where the shares are going high is so high, like you got so many shares compared to other shares and money. You don't want to put your eggs in all in one basket. So the value of your portfolio, because these stocks are these dividends are jumping and going up, what's happening is a lot of the value of your portfolio the percentage is going with the stock that's giving you the dividends and has the higher dividend return rate. So what you want to do is sometimes you want to take and shed some of those shares, take the money from that, and then go buy into other positions to even out your portfolio. You know. Now, one more thing I forgot to add is, you know, I talked about the three companies I like. You know, I categorize my holdings in, you know, growth, cyclical, and if it's a dividend aristocrat or a blue chip stock, you know. So what I usually do with the growth stocks, like I might have the growth stocks, and if it's a growth stock basically is a company that generates substantial and sustainable positive cash flow, whose revenues and earnings are expected to increase at a faster rate than another company in its industry. Now, growth stock usually doesn't pay a dividend because they take their money and they put it back into R&D, you know, research and development, to get the company to grow faster and faster. Now, a lot of times these are tech companies, or these are companies like Tesla, you know, where if they do give a dividend, it's very, very small, and most of their money goes into the growth of the company and making new products and stuff like that. Now, with me being a value investor, most of my stocks that I have in my portfolio are more blue chip stocks. These are stocks that are like proven, like, you know, your Johnson & Johnson's, other stocks like Waste Management, things like that are going to be in demand forever, you know, until something greater comes along. But they usually have big moats where they are protected with their style of business and the way they do things, like Coca-Cola. Like these are brand name brands that are like worldwide recognized. So, you know, you should never feel bad about your stocks, selling your stocks. You shouldn't feel bad about you know, making a decision to sell your stocks. That's why when it comes to investing, it always comes down to you and what you want and what direction you want to go in life. You know, as far as financially in life. Let me correct that. But that's it for this little bit of this little guide of how I do stocks and sell stocks. I hope it was educational for you. I hope you got some type of you know, you learned something out of it. And I'll see you in the next video. I appreciate your time, you spending time with me. As always, I'm Steve. And if you could, hit the thumbs up button, share and subscribe, and I'll see you in the next video. Thank you, and take care as usual.